Crypto Bloodbath 2025. The crypto market is bleeding, and there's no denying it. Bitcoin, down double digits. Ethereum, slipping hard. Altcoins, absolutely crushed. Billions wiped out in a matter of hours. But before you panic sell your portfolio or delete your crypto app, ask yourself this: is this destruction, or is this the setup for generational wealth? Let's break it down. What's really causing this bloodbath? It's not just fear. It's fundamentals meeting FOMO. The market's reacting to one macro pressure: interest rates staying high and global liquidity tightening. ETF delays, spot approvals for altcoins postponed, shaking retail confidence. Three whales taking profit. After months of green, the big players are cashing out, leaving small investors holding the bag. For sentiment crash, when fear spikes, algorithms dump harder. Bitcoin dominance rising means altcoins are bleeding heavier. When BTC drops 10%, small caps can drop 40 to 60%. That's not manipulation, that's the reality of volatility. But let's get some perspective. We've seen this before. Every bull run in history has one thing in common: a brutal correction right before liftoff. 2018, total collapse. Bitcoin fell over 80%. Everyone said it was dead. 2020, COVID crash. Bitcoin at $4,000, people said it's over. And yet, every single time, the market didn't just recover, it multiplied. The crypto bloodbath isn't new. It's the reset before the next big wave. Here's what smart investors are doing right now: accumulating strategically, not YOLO buying, but scaling in slowly while prices are low. Studying fundamentals, projects with strong teams, utility, and on-chain revenue. Watching on-chain data, exchange outflows, whale wallet movements, and stablecoin inflows tell the real story. Staying emotionally detached, fear makes you sell bottoms, patience builds wealth. The biggest mistake right now: thinking short-term. If you're playing the 10-year game, this bloodbath looks less like a crisis and more like a clearance sale. Some coins will fade away. Others will 10x when the dust settles. Bitcoin BTC. The king is still the safe play. Long-term institutional money flows here first. Ethereum METH, layered to growth and tokenization. Keep ETH relevant. Solana Sol, despite the volatility, it's becoming a top ecosystem for real-world applications. XRP, if regulation clears up, it could shock everyone next cycle. Phantom FTM, Avalanche AVAX, and AI-linked tokens, these are speculative, but early conviction pays. Remember, don't chase green candles. Accumulate red ones. Every bloodbath separates the tourists from the builders. The market doesn't reward panic, it rewards patience. This is the time to learn, to build, to prepare, because the next bull cycle doesn't start when the news says it does. It starts when no one's watching. Stay sharp, stay grounded, and remember,
if this video helped you see the bigger picture, smash that like button, subscribe, and share it with someone panicking right now. The crypto bloodbath isn't the end, it's just the cleansing before the next rise. I'm ViCrypto7, and I'll see you on the next one. Until then, stay focused, stay fearless, and stay in the game. Disclaimer: please note that cryptocurrency prices can be highly volatile, and this information is intended for educational purposes only. It should not be considered financial or investment advice. Always conduct your own research before making investment decisions. The content and materials featured on this page are for educational purposes only. ViCrypto is committed to providing unbiased and transparent reporting. This video aims to deliver accurate and timely information but should not be taken as financial or investment advice. Since market conditions can change rapidly, we encourage you to verify information on your own and consult with a professional before making any decisions based on this content. The information provided in this video is for informational purposes only. It is not intended to be, nor should it be construed as, financial advice. We do not make any warranties regarding the completeness, reliability, or accuracy of this information. All investments involve risk, and past performance does not guarantee future results. We recommend consulting a financial advisor before making any investment decisions.
Start your day with ViCrypto, your morning coffee, but for crypto lovers.
Watching my portfolio grow while sipping my morning brew is pure bliss. From NFTs to coins, ViCrypto makes managing all my assets a breeze. Get in on the action, grab ViCrypto now, and watch your investments thrive.
If you're experiencing unusually high gas fees when claiming your mined star crazy, GFT on the IoTeX network, it's crucial to investigate several potential underlying causes. The first factor to consider is network congestion. While IoTeX is generally characterized by low fees, surges in user activity can significantly drive up gas costs. Such congestion may stem from multiple users attempting to claim their rewards simultaneously. A recent governance forum discussed increasing the block gas limit to accommodate the surge in transactions, illustrating this strain on the network. Another critical factor impacting your gas fees could be the complexity of the claim transaction itself. Unlike straightforward token transfers, claiming GFT often involves executing smart contracts. The intricacies embedded in the smart contract, such as assessing your digging power and calculating your claim, require more computational resources, thereby increasing the gas utilized for the transaction. Your wallet's gas price settings might also play a role. If your wallet is configured to automatically set a high gas price to expedite transaction processing, you could find yourself paying more than necessary. Additionally, if the network's recommended gas prices have surged and your wallet reflects this, you could be facing inflated fees. Minimum balance requirements in IoTeX for conducting operations within StarCrazy further complicate the situation. According to guidelines, maintaining at least 10 IoTeX in your wallet is mandatory to cover gas fees. If your balance is hovering around this minimum, your wallet may automatically adjust the fees to account for potential transaction failures, adding to the expense. Promotional activities or unforeseen bugs may also influence gas prices. High volumes of users claiming rewards or participating in campaigns can momentarily increase network fees. Moreover, unexpected changes in gas costs due to contract upgrades or latent bugs can alter your transaction costs. To mitigate these issues, consider monitoring current gas prices on an IoTeX dashboard to evaluate their levels before proceeding. Ensuring you maintain a comfortable buffer of IoTeX will help secure a successful transaction without unexpected retries. Seeking opportunities during less congested times can also optimize your gas fees. Finally, keep an eye on official project announcements to remain informed about potential issues affecting fees. These insights are invaluable for making swift decisions regarding your claims. In the world of blockchain gaming on StarCrazy, claiming GFT can often lead to unexpectedly high gas fees, raising questions and concerns for players. Understanding the nuances behind these costs can demystify the claim process. Allow us to delve into some key reasons behind these elevated fees and equip you with the knowledge needed to navigate them effectively. The claim operation on StarCrazy is not merely a straightforward token transfer. It often involves a dynamic smart contract call, which inherently requires a higher gas limit. This additional complexity, while allowing for advanced functionalities within the game, translates to increased gas consumption for each transaction. Therefore, it's essential to recognize that while you might be making a simple claim, the underlying process demands a greater investment in gas, elevating your overall fees. Network conditions play a significant role in gas prices as well. At peak times when numerous players rush to claim their GFT rewards simultaneously, the competition for timely transaction inclusion leads to a surge in gas prices. This elevation is a necessary response to ensure that transactions are processed without delay, contributing to the steep rise in fees during busy periods. Players may find themselves bidding against one another for priority, ultimately hiking up the costs associated with gas. Additionally, the way your wallet sets gas prices can impact the fees you incur. Some wallets automatically opt for a safe gas price, which could be higher than the bare minimum required to facilitate your transaction. As a result, understanding how to adjust these settings could save you from unnecessarily paying inflated fees. The complexity of the claim contract itself may also encompass hidden costs involving internal operations and storage updates, which compound the overall gas required per transaction. To stay informed, monitor the network, and utilize tools such as the IoTeX API's Suggest Gas Price functionality. This will provide a baseline for assessing current gas prices. If your fees far exceed those of traditional simple transfers, it's a clear indicator that complexity and network congestion are at play. By timing your transactions during less congested periods and fine-tuning gas prices, you can navigate StarCrazy's ecosystem more efficiently, optimizing your claiming experience while minimizing costs. Before proceeding with any investment or transaction, Remember to perform due diligence, as the world of cryptocurrencies can be volatile. Stay educated, keep a watchful eye on network conditions, and enjoy your time in the vibrant universe of Star Crazy while making smart economic choices. Welcome back to the discussion on the current state of the IOTEX blockchain. As we dive into the reality of the situation, it's vital to address the absurdity surrounding the gas fees connected with operations on platforms such as Star Crazy. As gamers and investors alike attempt to carry out standard actions, they are met with staggering charges upward of 7 million IOTX, an outrageous amount exceeding $60,000 just to claim a handful of mined tokens. This isn't just a minor inconvenience. It reflects a growing dysfunction in DeFi that needs immediate attention. Let's break down what players actually experience. Many users, myself included, face shocking fees when trying to engage in basic functions like claiming GFTs, swapping IOPs, or fusing NFTs. Hours of gameplay and investment can be dashed in a blink when a simple transaction triggers a jaw-dropping gas fee. These aren't irrelevant complaints or fake graphics. They represent genuine issues occurring live on the IOPay wallet, creating an alarming scenario where players feel exploited instead of empowered. The justifications floating around are disheartening at best. The community hears excuses such as, "It's just a bug with gas estimation," or "the RPC nodes being quirky." Yet this persistent issue highlights a much deeper problem. If a blockchain struggles with executing its smart contracts efficiently, leading to a faulty gas calculator, we cannot ignore the implications. This suggests significant instabilities at multiple levels, particularly concerning node functionality and poor integration between decentralized applications, dApps, such as Star Crazy and the IOTEX blockchain itself. The repercussions of these gas fees spiral into serious hazards. IOTEX built its reputation on being a cost-effective, efficient blockchain designed for microtransactions and IoT applications. However, increasing fees and transaction hangs create detrimental impacts that ripple throughout the ecosystem. Players disengage, liquidity dwindles, and asset values drop as trust erodes. The chain's inability to provide reliable, reasonably priced transactions could eventually lead to a mass exodus of dApps and users alike. It's crucial for the IOTEX team to acknowledge these problems at both the validator and RPC levels, rather than dismissing them as mere front-end glitches. Blowing off these severe gas fees is a clear indication that the architecture harbors deeper flaws that, if left unaddressed, may drive more projects toward the exit door. Without intervention, IOTEX could face a debilitating loss of user confidence, jeopardizing its future in the crypto landscape. Largest Bitcoin seizure in U.S. history. $15 billion scam network uncovered. Welcome back to ViCrypto7, your home for crypto news, investigations, and the stories shaping the future of digital finance. Today, we're diving into one of the biggest crypto scandals ever uncovered on U.S. soil. A massive $15 billion Bitcoin scam empire linked to an alleged Chinese billionaire, exposed by the U.S. Justice Department. On 2721 Bitcoin seized, a worldwide scam network, billions laundered through shell companies, and ties stretching from the U.S. to Cambodia to China. This isn't a Netflix special, this is happening right now. So let's break it all down. Here's what we know so far. According to newly released court filings, the U.S. Justice Department filed a civil forfeiture complaint linked to over 127,000 BTC, valued at roughly $15 billion at the time of seizure. This Bitcoin haul is connected to what authorities describe as a massive, multinational scam operation, allegedly orchestrated and financed by a Chinese billionaire, with operations running primarily out of Cambodia. So how did this empire actually operate? Authorities say the organization used a mix of butchering scams, romance plus investment scams targeting Americans, phony trading platforms, fake investment consultants, shell companies in multiple countries, crypto mixing and laundering services. Victims were convinced to deposit crypto into platforms controlled by the network, and once the money went in, it never came back. To give you an idea of how huge this is, 127,271 BTC is one of the largest Bitcoin seizures in world history. That is more Bitcoin than the reserves of most public companies. The operation created a global web of fraud, trafficking victims forced to work in scam compounds, and enormous capital flows disguised through offshore entities. This wasn't a small-time scam. This was a fully industrialized crypto crime machine. Federal investigators spent months tracing blockchain transfers, uncovering how Bitcoin from victims was moved through dozens of wallets, privacy services, and exchanges. Eventually, they linked the funds to accounts controlled by this alleged billionaire's network. This led to the massive civil forfeiture move. The government now holds one of the largest Bitcoin stashes ever seized. So what does this mean for everyday crypto investors? Number 1, crypto scams are becoming more sophisticated than ever. These aren't teenagers on laptops. These are large organized groups with real infrastructure. Number 2, the US government is stepping up big time. This seizure shows they are willing to chase criminals across borders, across exchanges, and across blockchains. Number 3, more regulation is coming, and fast. Let's talk market reaction. Whenever the government holds a big chunk of Bitcoin, traders instantly start asking, are they going to sell it? Will this dump the market? Is this bearish for BTC? Historically, government-held BTC is auctioned in batches and usually announced well in advance. No sudden dumps. So short-term, this isn't a threat to Bitcoin's price. Long-term, and it's a reminder, crypto is growing up and the Wild West is ending. This case highlights a harsh truth. Where there is money, especially crypto money, there will always be people trying to exploit it. But it also shows the power of blockchain transparency. Even with laundering attempts, mixers, and shell companies, Bitcoin's ledger never lies. And that's ultimately how investigators followed the trail. This is one of the biggest crypto takedowns in history. And we were still waiting for more arrests, more documents, and more information to be released. As always, I'll keep you updated here on ViCrypto as the story unfolds. If you found this breakdown helpful, hit that like, subscribe, and drop a comment. Should governments hold seized Bitcoin or auction it immediately? Thanks for watching ViCrypto, where knowledge is profit. Stay safe, stay smart, and stay crypto.
What's up, ViCrypto family? Welcome back to the channel where we break down the biggest moves in crypto so you stay ahead of the game. Today, we need to talk about a project that just woke up the entire market, Raincoin, which absolutely exploded with a 96.3% pump in the last 24 hours. Yes, almost doubling in a single day. So let's dive into what caused this move, whether it's sustainable, and what you should watch next. What is Raincoin? Before we jump into the price action, let's quickly break down what Raincoin actually is for anyone who may be new. Raincoin is a project built around AI-powered decentralized tools, with a focus on predictive analytics, on-chain insights, and user-friendly automation for traders. Their goal is to make AI accessible to both beginners and advanced crypto users. Some key features often highlighted include AI-generated market signals, cross-chain supportive infrastructure, high-speed execution layer, community-driven governance model, a growing ecosystem of micro-apps. Nothing crazy on the surface, but enough fundamentals to get attention when volume hits the chart. The 96.3% pump. What happened? Alright, now let's get into the real story. Why Raincoin pumped 96.3% in 24 hours. Here are the major catalysts behind the explosive move. 1. Sudden spike in trading volume. Within hours, Raincoin's trading volume surged, more than 4x its daily average. When liquidity and volume hit smaller cap tokens, the price can rocket fast. 2. New partnership, feature rollout, likely catalyst. Raincoin recently teased a new AI trading tool update, and insiders were already buzzing. When the update went live, the community surged in. Even if the news wasn't huge, the timing was perfect. 3. Social media hype. Crypto Twitter went crazy over one chart showing Raincoin breaking its resistance. A few key influencers mentioned it, and suddenly retail interest flooded in. This wasn't just a slow, organic rise, it was a momentum-driven spike. 4. Whales entering the chart. On-chain data from trackers showed several large wallets making fresh buys, likely anticipating a breakout. Whale activity often triggers FOMO from small traders. Raincoin went from a consolidation zone straight into a parabolic breakout. Technically speaking, it broke major resistance on the 4-hour chart. Volume candles were the largest in weeks. RSI moved into heavily overbought territory. Market sentiment flipped bullish instantly. Price action like this usually indicates one of two things: the start of a larger trend. 2. A temporary hype rally. Which one is Rain? Let's evaluate the fundamentals. Now the real question, is this a one-day wonder, or the beginning of something bigger? Bullish signs, volume supports the move, not a fake wick. New features bring real utility, strong social traction, entry from larger wallets. Bearish signs, RSI extremely high, cooldown inevitable. Still a small cap coin, prone to volatility. Hype-driven pumps often retrace 20–40%. This is where risk management becomes crucial. A coin pumping nearly 100% in 24 hours is never a guaranteed continuation. Momentum traders might lock profits, causing pullbacks. Short-term, next 24–72 hours, expect volatility. Raincoin could pull back and retest support. Consolidate sideways. Attempt a second leg up if volume stays strong. A key level to watch is the previous resistance. If Rain flips that into support, momentum could continue. Long-term, weeks to months. The long-term potential depends on continued development of AI tools, ability to grow its user base, delivering actual utility beyond hype, keeping whales engaged. Raincoin is in a sector, AI plus crypto, that remains one of the strongest narratives. If they execute, this could be the beginning of something bigger. This isn't financial advice, but here's the strategy most experienced traders follow during massive pumps. You don't chase green candles. You wait for a pullback, a retest, consolidation, clear confirmation of trend continuation. Buying after a 96.3% pump is high risk unless you're playing short-term volatility. If you do enter, consider tight stop loss, small allocation, no emotional trading. Always remember, the market owes you nothing. Raincoin just shocked the crypto market with a nearly 100% pump in a single day. Whether it's the start of a bigger run or just a temporary spike, one thing is clear, this project just put itself on the radar. Crypto moves fast. One day you're unnoticed, the next day you're trending. If Raincoin keeps delivering on its AI roadmap, we might be seeing the early stages of a larger narrative. But as always, stay smart, stay informed, and never invest more than you can afford to lose. If you enjoyed this breakdown, smash that like button. Subscribe to the ViCrypto channel.
Welcome back to the channel. With the anticipation of a crypto surge as we approach the new year, it's time to focus on a project that is capturing attention, Solana. Known for its speed and innovation, Solana is often seen as a major competitor to Ethereum. But what if Solana's market cap matched that of Bitcoin? Let's delve into the numbers and implications. Solana versus Bitcoin. Potential value of Solana, launched in 2020, is a standout in the blockchain world due to its ability to address the limitations of Ethereum and other older blockchains. Its high transaction speed up to 65,000 transactions per second, and cost efficiency make it a formidable player. Solana's unique proof of history post system enhances scalability without sacrificing security, attracting a variety of decentralized applications dApps, DeFi platforms. Current market comparison bidding's market cap generally around $1 trillion, making it the undisputed leader in the cryptocurrency market. Solana's market cap, typically between $10 and $20 billion, significantly lower than Bitcoin's. If Solana were to achieve a market cap similar to Bitcoin's, it would mean a dramatic increase in SOL's value, potentially reshaping the entire cryptocurrency landscape. Factors influencing Solana's growth. Several factors could impact Solana's potential to reach Bitcoin-like market cap levels. 1. Adoption and usage. Solana needs to grow its user base and dApp ecosystem to compete with larger blockchains like Ethereum. 2. Emerging competitors. New blockchain technologies could challenge Solana's growth. 3. Regulation. Regulatory changes could affect Solana's expansion. 4. Cryptocurrency market cycle. Market cycles are unpredictable and could influence Solana's ability to reach such a high market cap. Theoretical price calculation assuming Bitcoin's market cap of approximately $1 trillion and Solana's circulating supply of 411 million SOL tokens. A theoretical price for SOL would be around $2,430 per token. This represents a substantial increase from its current price range of $248 to $269. However, these calculations are speculative and depend on numerous market factors. The potential of Solana in the future. The prospect of Solana reaching Bitcoin's market cap reflects its immense potential. If Solana continues to innovate and capture a larger share of the global market, its value could see significant growth. Nevertheless, cryptocurrencies are inherently volatile and speculative, so investors should exercise caution. Investors and enthusiasts should keep a close watch on Solana's developments and broader market trends. As always, consider diversifying investments and understanding the risks involved. Final thoughts: the idea of SOL reaching a price point in the thousands is fascinating and highlights the potential for growth in emerging cryptocurrencies. However, achieving such a milestone would require widespread adoption, technological advancements, and likely a transformation in digital currency infrastructure. Feel free to share your thoughts in the comments below. Remember, this discussion is not investment advice. Always conduct thorough research before making investment decisions. For more updates, consider supporting us via Patreon. If you found this content helpful, please like and subscribe to our channel. Thank you for watching and have an awesome day.
Yo, welcome back to ViCrypto7, where we break down what's really happening behind the charts. Today we're digging up some coins people used to hype like crazy. Bipro, Jasmy, MTV, Cadena, Casper, VeChain, Harmony One, FTM. Dear, some exploded, some collapsed, and some are silently setting up for a comeback. Let's find out which ones died, which ones survived, and which ones might surprise everybody this cycle. Bipro was supposed to be the future of decentralized code repositories, basically a GitHub on blockchain. But the hype outpaced the actual adoption. Development slowed, partnerships faded, and the community shrank. Not dead, but nowhere near the next big thing people expected. Jasmy coin gained insane attention because it branded itself as the Japanese IoT data coin. Problem? The supply is huge, the tokenomics crushed early investors, and the project never delivered the enterprise adoption it promised. Still, every bull run, Jasmy wakes up just enough to lure in new hype. But long-term fundamentals? Still questionable. Multiverse X, formerly MTV, had fast, scalable, sharded blockchain tech. But just like many small L1 projects, it suffered from weak marketing, lack of major ecosystem apps, slow onboarding of developers. The tech wasn't ET bad, but the momentum disappeared. Cadena is still one of the most technically strong blockchains, hybrid POW, scalable, secure. But it launched right before the market collapsed, and adoption slowed because teams didn't want the complexity of learning the packed language. Right now it's not dead, just sleeping. If devs adopt it again, it could pop. Casper is the only coin in this list that actually delivered a breakout moment. Pure proof of work, Ghost DAG protocol, extremely fast finality, and a real miner community. Casper went from forgotten to one of the most explosive L1 stories of this cycle. This one didn't die, it evolved. VeChain didn't become the global supply chain revolution like people thought in 2021. But unlike many coins, VeChain has real-world business partnerships, proven enterprise adoption, consistent development. The price struggled, but the project itself is alive and working. Slow and steady, it's not hype-driven. Harmony One collapsed mostly due to the $100 million Horizon bridge hack. Investors lost confidence. The team made weak decisions, and momentum died. Harmony still exists, but the trust is gone. Most investors consider it a failed project at this point. Phantom had a massive fall after developer Andre Cronje stepped away in 2022. The ecosystem crashed. Sentiment died, and people abandoned the chain. But Phantom stabilized, rebuilt, and recently pushed updates like Sonic, speed upgrades, and better dev incentives. This one might shock people again during the bull run. Near never fully collapsed. It just got overshadowed. It's actually one of the most advanced smart contract platforms with a strong dev community. Near focuses on real usability, not hype. And with AI plus blockchain integrations on the rise, Near could become relevant again fast. Some of these coins died, some are sleeping, and some, like Casper, FTM, and Near, are positioning for a serious comeback. If you want more deep dives like this, smash that like button, subscribe to the channel, and let me know in the comments which old coin I should cover next. ViCrypto7, bringing clarity back to the crypto chaos. See you in the next one.
The coins showed some strong upward movement in the past 24 hours.
What really happened to these coins? What's good, family? Welcome back to ViCrypto7, where we cut through the hype and break down the truth behind the biggest moves in crypto. Today, We're talking about 7 coins everyone keeps asking about. Chainlink, Render, Celestia, Kronos, Bonk, Stellar, and Jupiter. Some pumped hard, some stalled, and some completely confused the market. But don't worry, I'm going to break down what really happened, why price action shifted, and what it means moving forward. Let's jump right into it. Chainlink. Let's start with Chainlink, one of the most important infrastructure plays in crypto. What happened? Link pumped heavy earlier because institutions started tapping into CCIP, Chainlink's cross-chain interoperability protocol. It became a real backbone for tokenized assets. But recently, the hype cooled because big CCIP partnerships didn't instantly translate into volume. Staking V2 rewards flattened. Smart contract activities slowed during market rotations. The truth, Link is no hype coin. It's an infrastructure play that moves slower than narrative coins. It's building, even when price takes its time. Render, RNDR. B-roll, AI graphics, GPU renderings. Render had one of the strongest AI runs in the entire market. Why it pumped AI narrative. GPU demand, Fox Render partnerships, community strength. Why it slowed down, large early investors took profit. AI token hype rotated into new launches. Network usage didn't grow as fast as speculation. The truth, RNDR is still one of the most credible AI tokens. But narratives move fast, and rotations hit every project eventually. Celestia, TIA. Celestia exploded because it introduced modular blockchain architecture, separating execution from data availability. Then the dip came. Why? Early stakers and airdrop farmers took profits. Modular became a crowded narrative. TIA inflation from staking rewards put pressure on price. The truth. Celestia is still a top modular leader, but you can IT avoid token unlock cycles. Fundamentals strong, but tokenomics matter. Kronos, Sarah. CRO had a massive run last cycle thanks to crypto. Comms branding and staple center deal. But this cycle, why it stalled? Growth slowed at crypto. Competition in exchanges increased. Ecosystem expansion lagged compared to Solana, Cosmos, and Ethereum L2s. The truth, CRO needs fresh catalysts and new ecosystem energy, not just branding. Bonk, the Solana meme coin king. Why it pumped Solana mania. Massive community activity, integrations across wallets and games. Bonk rewards everywhere. Why it did, it's a meme coin. Whale rotations, profit taking, and hype cycles always hit hard. The truth, if Solana keeps running, Bonk stays relevant. But meme coins move like roller coasters. Expect volatility. Stellar, XLM. Stellar is one of crypto's oldest projects. What happened? It hasn't kept up with newer, more exciting narratives. No major new ecosystem growth. Real-world adoption moves slowly. Ripple steals most of the spotlight. Utility doesn't always equal price movement. The truth, XLM is stable, legit tech, but the market chases hype, not stability. That's why it moves slower. Jupiter, JUMP. Jupiter was one of the strongest launchers on Solana. Why it pumped, massive airdrop. Best aggregator on Solana. Trading volume explosion. User loyalty. High TVL. Why it cooled, airdrop farmers selling. Whales hedging. Market rotation away from DEX tokens. The truth, Jupiter is still one of the strongest real utility tokens on Solana. Dips were expected after one of the biggest airdrops ever. Crypto doesn't move randomly. Every pump, every drop has a story. Chainlink, slow builder. Render, AI hype adjustment. Celestia, tokenomics pressure. Kronos, ecosystem slowdown. Bonk, meme coin rotations. Stellar, old tech versus new narratives. Jupiter, post-airdrop reality. Understanding these cycles helps you level up your game, not panic during dips. If this breakdown helped you, hit that like, comment, and subscribe for more deep dives from ViCrypto7. Drop a comment telling me which coin you want next, and I'll break it down in the next video. Until next time, stay smart, stay focused, and stay crypto.
Welcome back to the channel, ViCrypto family. Today, we're diving into one of the shadiest stories in crypto exchange history. A story many of us lived through firsthand. A story about an exchange that once looked promising, but ended in chaos, confusion, and millions of dollars in frozen assets. Today, we're breaking down what really happened with Hotbit, how users lost their tokens, and the red flags we all missed. If you ever used Hotbit or lost money there, this one's for you. What Hotbit was supposed to be. Let's start at the beginning. Hotbit launched in 2018 as one of those small, fast-growing Asian crypto exchanges promising everything we wanted. Hundreds of new coins, low fees, early listings, staking rewards, liquidity mining, and a UI that looked clean enough to feel legit back. Then, for many retail users, Hotbit was the place to grab microcap gems before anyone else. They marketed themselves as the exchange for high-quality assets. Ironically, it became the exact opposite. The red flags we should have seen. At first, everything seemed normal, but slowly the cracks started showing. Red flag near 1, too many random tokens. Hotbit listed everything. If a project had a website, a logo, and a dream, they listed it. Hundreds of coins nobody ever heard of. Zero due diligence. But most of us thought, wow, early access. This is bullish. Red flag number 2, staking rewards that made no sense. Hotbit offered APYs so high they made DeFi look conservative. 50%, 80%, even 600% on tiny, unknown tokens. People started suspecting something was off. But again, if they're paying us, it must be legit. Red flag number 3, withdrawal issues. Every so often, withdrawals were under maintenance. Certain tokens would get temporarily disabled for weeks. And the support team, either copy-paste answers or no response at all. Red flag number 4, KYC optional. That should have been a major red alert. Any exchange letting you hold assets with no proper compliance is begging for trouble. The collapse begins. Hotbit freezes all assets. Then things escalated. In August of 2022, Hotbit dropped a bombshell announcement. All trading, deposits, and withdrawals were suspended. Not in a few hours. Not in a few days. Effective immediately. They blamed a police investigation into a former employee frozen company funds and security risks. They told us everything was fine. Just temporary. User assets are safe. We'll be back soon. But soon turned into months. And during that time, the truth spilled out. Hotbit was running on borrowed money. They relied heavily on risky DeFi investments. They mismanaged funds, and they were losing money faster than they could replace it. The final shutdown. In May of 2023, Hotbit announced its final message: we are shutting down permanently. They told users they had a short withdrawal window. But here's the catch. Most tokens weren't withdrawable. Dozens of networks were disabled. Balances didn't match. Fees were outrageous. And support gave zero help. People logged in and saw tokens stuck in maintenance. Tokens removed entirely. Tokens converted without permission. Tokens frozen because the blockchain was offline, or worse. A balance of zero. The shutdown felt like a slow rug pull. How much users actually lost? The total damage? Almost impossible to measure. But based on user reports, millions in assets vanished. Entire communities wiped out. Some users lost their life savings. Others lost early gems that would have 10x'd. Some people lost meme coins that later pumped. Some lost staking profits they thought were compounding. And worst of all, most users never received a single cent back. Crypto Twitter was full of comments like, I had $3,000 of tokens I can ET withdraw. My coins disappeared completely. Hotbit stole everything. I got scammed and can't do anything. Why Hotbit failed. So what actually went wrong? Reason number 1, poor liquidity and mismanagement. Hotbit spent more money than it made. They invested user funds into risky products. They depended on circulation rather than real revenue. Reason number 2, no proper regulations. Their lack of compliance caught up with them. When authorities stepped in, everything froze. Reason number 3, too many worthless tokens. Most of the assets traded on Hotbit weren't real projects. They were hype coins, rug pulls, or abandoned. Reason number 4, their business model was never sustainable. An exchange cannot survive by paying unrealistic APYs. At some point it collapses, just like Celsius, FTX, and others. The lesson for all crypto investors. So what can we learn from Hotbit's downfall? 1, not every exchange is safe. If a platform seems too good to be true, it probably is. Du high APY shu high risk. Crazy yields mean the platform is using your money for something risky. 3. If KYC is optional, run. That means regulators aren't watching.
For hold your crypto on private wallets. Not your keys, not your coins has never been truer. 5. If withdrawals keep freezing, it's a warning. We all thought Hotbit was just having technical issues. Turns out, we were watching the early signs of collapse. Hotbit is a perfect example of why the crypto world needs both innovation and responsibility. Millions of dollars lost, thousands of people burned. And one more reminder that in crypto, trust is everything. If you used Hotbit or lost tokens, drop your experience below in the comments. Your story might help someone avoid the next Hotbit. If you found this video valuable, smash the like button, subscribe to ViCrypto, and turn on notifications so you never miss a deep dive like this. Stay safe, stay smart, and I'll catch you in the next video.
Welcome back to ViCrypto7, where we break down the real projects shaping the future of crypto. Not the hype, not the fluff, but the infrastructure that everything else depends on. Today we're diving into the top 10 infrastructure layer projects to watch in 2026. And trust me, some of these are future 20x, 50x, even 100x beasts if they hit full adoption. Let's jump right in. 1. 002Z, the blockchain fastlane. 00 is basically building fiber optic fast lanes for blockchains. Imagine validators and chains communicating over private, ultra-low latency networks instead of public internet traffic. If demand for high throughput keeps growing, 00 could become essential. High risk? Yep. High reward? Absolutely. Two-pocket network, POKT. Decentralized RPC. Whenever you use a wallet or dApp, you're hitting RPC nodes. Pocket Network decentralizes that entire system, giving developers a faster, censorship-resistant data pipeline. As chains scale, RPC demand explodes. Pocket is positioned perfectly. 3. Space and Time, SXT, Blockchain, S-Data Warehouse. This project is wild. It lets you run SQL queries on both on-chain and off-chain data, then gives you zero-knowledge proof that the answer is tamper-proof. This is huge for AI plus blockchain, analytics, institutional auditing, and DeFi. Plus, it already has grayscale exposure. Bullish. 4. Celestia, TIA, Modular Scaling King. Modular blockchain architecture is the biggest shift since Ethereum. Celestia acts as the data availability layer for L2s and app chains. It's already becoming the backbone for rollups, and demand is just starting. 5. Chainlink, Link, the Oracle Empire. Chainlink dominates real-world data on-chain, but now with CCIP, it's also becoming a leader in cross-chain messaging. Chainlink might remain the #1 infrastructure provider in all of crypto. Flags Layer 0, ZRO, omni-chain connectivity. If you use bridges, swaps, or cross-chain dApps, Layer 0 is involved. Its messaging protocol is integrated across dozens of major ecosystems. Omnichain is the future, and Layer 0 is already running it. Since Cosmos, Atom, the Internet of Blockchains. Cosmos is old, but still early. IBC connects hundreds of chains, and more are joining every month. If the multi-chain world wins, Cosmos becomes unstoppable. War Avalanche, AVAX, Subnet Power. Avalanche lets you make custom blockchains called subnets. Perfect for your gaming, institutions, enterprises, real-world assets. Its architecture is clean, fast, and flexible.
Welcome back to ViCrypto7, where we break down the real projects shaping the future of crypto. Not the hype, not the fluff, but the infrastructure that everything else depends on. Today we're diving into the top 10 infrastructure layer projects to watch in 2026. And trust me, some of these are future 20x, 50x, even 100x beasts if they hit full adoption. Let's jump right in. 1. 002Z, the blockchain fastlane. 00 is basically building fiber optic fast lanes for blockchains. Imagine validators and chains communicating over private, ultra-low latency networks instead of public internet traffic. If demand for high throughput keeps growing, 00 could become essential. High risk? Yep. High reward? Absolutely. New Pocket Network POKT, decentralized RPC. Whenever you use a wallet or dApp, you're hitting RPC nodes. Pocket Network decentralizes that entire system, giving developers a faster, censorship-resistant data pipeline. As chains scale, RPC demand explodes. Pocket is positioned perfectly. WAM, Space and Time, SXT, blockchain's data warehouse. This project is wild. It lets you run SQL queries on both on-chain and off-chain data, then gives you zero-knowledge proof that the answer is tamper-proof. This is huge for AI plus blockchain, analytics, institutional auditing, and DeFi. Plus, it already has grayscale exposure. Bullish. 4. Celestia, TIA, Modular Scaling King. Modular blockchain architecture is the biggest shift since Ethereum. Celestia acts as the data availability layer for L2s and app chains. It's already becoming the backbone for rollups, and demand is just starting. 5. Chainlink, Link, the Oracle Empire. Chainlink dominates real-world data on-chain. But now with CCIP, it's also becoming a leader in cross-chain messaging. Chainlink might remain the #1 infrastructure provider in all of crypto. 6. Layer 0, ZRO, omni-chain connectivity. If you use bridges, swaps, or cross-chain dApps, Layer 0 is involved. Its messaging protocol is integrated across dozens of major ecosystems. Omni-chain is the future, and Layer 0 is already running it. 7. Cosmos, Atom, the Internet of Blockchains. Cosmos is old, but still early. IBC connects hundreds of chains, and more are joining every month. If the multi-chain world wins, Cosmos becomes unstoppable. Oit Avalanche, AVAX, Subnet Power. Avalanche lets you make custom blockchains called subnets.
Pippin on Solana. AI plus meme plus social hype. High risk, high speculation. The good, strong narrative, fast growing community, low fee chain, and it can rip during a hype cycle. The red flags, no solid utility yet.
If you're waiting for confirmation, you're already late. This bull run won't reward intelligence, it'll reward position. And today I'll show you exactly what most people are missing. What's good, this is ViCrypto7, where we move before the crowd, not after it. If you want to understand